Well, if you look at how we've been draining the inventory stocks, we've been draining commercial stocks. The U.S. has also been draining its SPR at a very rapid rate. And so, if you look at all of the oil that's actually off the market, from the Middle East because of this stoppage, and then you look at the rate at which we're still using oil, we're draining our inventory stocks, really oil prices should be much higher. They're pricing in all of this expectation that there's going to be a peace deal, right around the corner. And at a certain point, we're going to drain our inventories. They're going to be essentially gone. Okay. And then what are we going to have left to fall back on? And so at some point, there has to be some kind of a price rise to accommodate for that. And, the question is really when are we going to see that? I think we've seen Exxon and Chevron saying it's coming pretty soon. Other people say maybe July, maybe not until late July, definitely by August. But it does seem like there is a great disconnect here, and that because prices have really remained below 100, we're not seeing the kind of demand destruction that we would need to see given how much supply is actually off the market.
Ellen, is there an expectation that there will, I'm not going to say always, but for the foreseeable future, be a risk premium for any of that energy that comes out of the Middle East that you just really cannot get comfortable with the Strait of Hormuz no matter what peace agreement comes?
I believe right now we are in we have fundamentally changed the way that oil flows out of the Persian Gulf at this point because, if you just take the Bab el-Mandeb Strait, for example, and not even nearly that much oil actually went through the Bab el-Mandeb because the Suez Canal can't even handle the largest crude carriers. Marine traffic has never returned to where it was after 2.5 years after these Houthi attacks. Now we've got the Strait of Hormuz closed. I mean, that risk premium is never going to go away. Combined with the fact that we're now going to see Gulf oil countries, we're going to see them building more pipelines. They are going to see pipelines as a national security imperative, whereas before it was something that might be nice if you had the money to do it. Now it's a national security imperative, and so I do think that oil flows will be forever changed because of this. Because no matter what, there's always the idea that this could happen again.
When you say that pipelines are a national imperative, who's that good for? Who gets left out?
Well, so that's an interesting story because Saudi Arabia and the UAE have been in a relatively good position because they'd already built pipelines. They're definitely going to be building more at this point to bypass the Strait of Hormuz. But then you've got countries like Iraq, Bahrain, Kuwait, Qatar that are basically trapped. Iraq has a small pipeline that goes up to a Turkish port, but Iraq can start investing in pipelines. Iraq has more options. They can go, all the way to Syria. Potentially, maybe they could go through Jordan to the Mediterranean and ship oil through there. You're going to have countries that are going to invest in oil storage all around the world just so that they can keep commercial stocks available the next time this happens. But really Kuwait and I would say Kuwait, Bahrain, Iraq, and Qatar, they're really in the worst position, and they're going to have to work together. They're going to have deals with other countries, with Oman, with the UAE, potentially even with Saudi Arabia, to secure pipeline access so that their crude, or at least a portion of their crude and their natural gas, can continue to flow the next time this happens.
Is there a risk that that whole part of the world, the Middle East, the 20% of oil that flows through the strait, that they lose market share to other producers around the world that, as a buyer on the margin, I'm not even going to talk to these guys in the Middle East?
So that's a possibility, but they always have the potential to lower their prices. Remember, these are big state oil
Yep.
producers. A lot of them are fairly well capitalized, particularly say the UAE and Saudi Arabia. And now there's an opportunity for these other producers to act in similar ways, to buy up storage capacity, to build storage capacity. Say, look, Saudi Arabia, Aramco has storage facilities in Egypt, for example. They have storage in Japan. They have storage all over the place, and that provided them with a great buffer to continue to be able to supply customers. They can't necessarily change the price of oil, although they can act through OPEC to impact it, but they can make it so that they have more built-in redundancies to be able to continue supplying their customers with oil, which in turn then makes their revenue more secure.
What are the U.S. producers saying, Ellen, about their production goals in the short term and the longer term?
Yeah, that's a really great question. I think we've seen some growth in terms of more wells, but not a whole lot. The question is really, I think producers are looking at these oil futures prices and they're saying, hey, look, these prices, yeah, they're higher, but how long is this 60% increase going to remain? Is it worth it for me to, diverge from this capital discipline that we've been practicing that has been so profitable, for them and to expand in a mass way? Or are they going to be looking for incremental ways to, produce more and take advantage of higher prices right now, without having to say lay out for massive new projects? And I think that that really depends on where oil prices go, in the next couple months. And also, once it becomes clear, say, if there is some kind of deal that reopens the Strait of Hormuz, it's going to be a long process. Things are not going to go back to where they used to be. But as that plays out, I think producers will have a better sense of how long they can expect, say, increased demand for their domestic oil in the United States and whether it pays to invest more and drill more.